I'd love to start a little bit more and talk a little bit about M and our relationship with M Financial Group, and why advisors also look to come to work with us. So I don't know if I want to turn it over. Ron, you've been on the board now with M for a couple years now, so if you want to...
Yeah, so this is actually our 20th anniversary, 20th year of having joined M, our firm, and it's been tremendous for our clients and for our team that supports those clients. It's just a very unique consortium of independent firms who are agnostic when it comes to insurance carriers and products, and for firms who are looking for the best solutions, the best vehicles to fit their client needs. We all service our clients, we all look for the best products, we all look for the best solutions, but what M put together 45 years ago is something truly unique in our industry, because every carrier has always had their own niche. What the pioneers of M figured out 45 years ago and pushed and really disrupted the industry to figure out is to find a way to offer differentiated products that are priced differently, underwritten differently, and serviced differently over a long period of time for affluent clients who look different than the average American. So I always give the analogy, I don't think it's the perfect analogy of, imagine there was an auto insurance company that only sold auto insurance to people who have never been in an accident, never had a ticket, a moving violation, they're perfectly pristine. They'd pay better auto insurance rates than the average American, right? So the life insurance products created by M Financial that we have exclusive access to are written for the affluent client who lives longer, pays their premiums, and don't let their policies lapse, and they buy larger policies because they have larger needs. So that's the benefit and the main story behind M. It goes much deeper than that in terms of the support that we are able to provide our clients, but that's the gist of it.
Marshall, in your experience, what benefits have you seen over the course of your time with M, and if you could expand upon it a little bit, that'd be great.
Well, having worked on the product development group, I've seen how they've used their 45 years of data, knowing exactly how long our high net worth clients live, how long they keep their policies, and how much better the pricing is. We've seen that and documented that, and I like what Adam says when he explains the difference between retail and non-retail products.
So when I explain the value of M and the history behind it, it's on the concept that off-the-shelf retail products didn't meet the needs of the ultra-affluent. So the founders of M band together to speak with the carriers to come up with something that was made for their clients. Because as Ron said, our clients live longer, keep their policies longer, and buy substantially more. Well, in the life insurance space, the longer a policy stays in force, the more advantageous it is for the insurance company. Well, if your clients are living the longest in the affluent market, then those are the best policies. But an insurance carrier can't just write that business because the risk would be too high. So the carriers come to the M firms collectively to be in that affluent market where the better specialty products are.
And there's a couple other things too that are, I think, really important, Brian. Excuse me. One of them is that for those of us who have been in the industry a long, long time, we all have, we've seen new iterations of products come out. And when a new iteration product comes out from XYZ Life Insurance Company, and the mortality and the pricing and the overall construction of that new product is more competitive than the old one, if you're a client who bought an old product 5 years ago, 10 years ago, well, you're just have to live with that product, right? That's the one you bought when you were, 5 years ago or 10 years ago. You're kind of stuck with it. You don't get the benefit of XYZ Insurance Company's better product that is now based on today's mortality and today's more competitive expense structure. In the M world, we get to go back to those clients and improve their policies and give them the benefit of the lower expense structure, the lower cost of insurance, the better cash value growth, whatever the case might be, because that's the commitment and that's part of the contractual deal that our partner carriers have signed on to. So we get to you buy a product, it's not just a product for then, it's a product that you get to improve upon if there are improvements over time.
Yeah, there's definitely a lot of negative connotations when it comes to the life insurance industry. Obviously, we all know it very well. One of the things I was actually reading in one of your books the other day, one of your pamphlets. Sorry, I hope I was kind of sifting through the office, the outside, but I think it's like servicing is like so important, and people tend to think that insurance, pay your premium, get it done, guy doesn't care, makes his money, goes home. Like service for us at our firm is one of the most important things that kind of differentiates us. If Marshall, can you talk about kind of the servicing process and how important that is?
Well, you have to have reasonable assumptions in your plan design. And then once you put that plan into place, then you have to have a system to monitor it and make sure that you're hopefully using appropriate assumptions, that you're ahead of plan, that you perform as well or better than you expected to. And we have those programs in place, both here and at Greenberg and Rapp, to do that.
So I like to say that life insurance fails for two reasons. It's poorly funded in the beginning, and it's poorly serviced. And the second one can take care of the first one. So life insurance really fails because it's poorly serviced.
So it's one of the ways that we think we set ourselves apart is we've been doing, not just because we've been doing it a long time, but you can't do it a long time if you're going to disregard or not pay attention to your existing customers. Because for us, we don't do any real outbound marketing, any of us. We all market ourselves through attorneys and accountants and existing clients who we want to come back to us for like other needs or their children's needs or their grandchildren's needs. And so if we're not servicing their policies and servicing their overall insurance and investment portfolios, they're not going to come back to us.
No, I had recently had one of my clients die, and his son, I was helping him with his death claims, and I know his son quite well. And the son was surprised that I was being so proactive in handling it. And I emailed him back. I said, when your father bought the policy, he also got a commitment from me that I was going to take care of him in the policy as long as it was in force. And that's the commitment that I make to all my clients. And I don't think a lot of people in the business today make that same commitment. And with them, we have the resources not just to make the commitment, but to back it up.
You know, it's interesting. Something that every once in a while I run into, there are clients, you know, when you're in the insurance business, you guys do broader work, you do, you know, financial planning, you do investments, you know, that's a natural thing where you meet with your clients every quarter, you're talking to them. Life insurance is a little more transactional, and it's not necessarily like you need to be with the client every year. There are some clients that make it hard to service them because they perceive you as somebody that sells. And coming back to see them, they view sometimes as not necessarily that you're there to service them, but you're there sometimes to come back and try to sell them something. So that's one of the issues. Most of my clients I don't have that issue with, but there are some that it's like, no, I'm fine, I think everything's good, you know, we don't need to get together. And, you know, sometimes you have to overcome that with clients, I've found, in the insurance side of the business.
How often would you say, Steve, then, on those types of clients, how often would you typically try to check in with them on the servicing? I know it depends on the person and, you know.
Look, I would say to you that, you know, depending the level of the client, you know, I like to see my clients once a year at a minimum, you know, just to touch base and see how the product performing, where they are in their life. I mean, let's be real. When you do meet with your clients, questions come up, things come up, there are opportunities, you know, and you know, it used to be, it's changed a lot. I would say the last 6 or 7 years, going into a new opportunity, a new situation, to review people's insurance, it's much, much more difficult to find opportunities where policies are not performing well and you can do something for somebody. You know, today, especially if they bought any kind of guaranteed policy, as long as they're paying for it properly, you know, those policies are really golden. You know, there's nothing you could do there. But like I said, I try once a year, I would say on average would be how often I like to, and most of my clients are fine with that, but there are people that, just think you're gonna try to sell them, so they just.
And I'd like to reiterate that point that we made earlier of, servicing and staying in touch with our clients and working with the families. Like, we are truly on the same side of the table as the people that we work with. A lot of time we get very close with a lot of those people that we work with because it's a very, very warm, respectful relationship. I think as this firm has grown and evolved, and again, we're blessed to have such an amazing group of intellectual individuals here. The goal here is for us to be able to extend, not just sell or help out patriarch who's now maybe in his late 70s and the kids are going to kind of be on their own. It's to be there for the longevity of it all. And I could speak on my behalf as a younger gentleman here. I mean, God willing, I have a longevity in this business and in this relationship long term with these families that we work with. So the goal here is for us to be there for a long time and to stay kind of steady and continuous. Something that I think all of our firms kind of work together collectively to be able to build and do. And
I know servicing has been very good for my business because in servicing my clients, I have second and third generation clients as a result of taking care of people. And sometimes, in some cases, I took care of policies that I didn't sell.
You pay it forward.
Yeah.
Right.
And it usually pays off somewhere along the line.
Yeah, so I would say, and one of the reasons that I'm with this firm is because I know I'm not going to be around to be able to service all of my clients. And I trust the people at Greenberg and Rapp and at Jones Lowry to be able to pick up the ball and carry it and take care of my clients when I can't. And that's
It's important.
that was the most important reason why I joined.
Brian, many of our clients don't really understand the benefit of the M Financial relationship, but the advisors that introduce us to their clients, they truly understand the two unique things. The one you mentioned, Ron, 45 years of data on our high net worth insureds. That's what's used to price the policies we offer, so that we really have non-retail policies that have better pricing than retail policies. In the back end, we have a reinsurance company. And through our reinsurance company, we spend about $50 million a year developing products and auditing our books of business so we can say we have never had a cost of insurance increase on any policy that we've sold through our M Financial program.
Yeah. And speaking of the reinsurance company, Marshall, in having our own reinsurance company, we're putting our money where our mouth is. We're taking on some of the risk ourselves. So if a client's buying a $10 million policy from Pacific Life or John Hancock, our own reinsurance company is taking on $1 million, $1.5 million of that risk. So when that client passes away, we're on the hook. So we're being very thoughtful and mindful about the clients with whom we work.
And having that reinsurance company really gives us a seat at the table to really look behind the curtain, where in the retail market, if there's losses in other areas of business, the insurance company is going to increase the cost of insurance on other blocks of business to make up for that loss. On our side, as Marshall said, we haven't had a cost of insurance increase, and that's because we hold our carriers accountable to our policyholders.
When I hear all this stuff from you guys, I don't even sometimes realize what I'm part of, and the power of them. Everyone kind of stays in your lane. You kind of do what you need to do on a daily basis, but it is truly a remarkable group that we're a part of, and it's super, super powerful. What else? What other questions on advisors? Marshall, do you have anything you want me to ask you particularly? And what's your best prep? Yeah. What do you think?
Well, we have to earn the right to be introduced to one of our advisors' clients. And so we earn that right by trying to provide value. And one of the ways we provide value is to do reviews of existing portfolios of insurance with with no intent to make a sale, but simply to help them understand the status of their policy and whether it's in their best interest to keep it, cancel it, replace it, settle it.
Yeah, I think that's the biggest thing for me too. Is it comes back to this just respectful family atmosphere and environment. Just being able to help the people that we work with is such a beautiful thing. It really is. It helps me wake up every day and be happy to go to work because I know I'm helping solve some puzzle for some family. And typically it's people that we want to work with, we want to talk to, we want to help. So for me, it's been such a pleasure being able to be part of this. And you guys
So often, people don't realize the value you provide to many years on.
Yeah.
But when you actually bring that family that check at the darkest time, you know, being able to give somebody a huge amount of tax-free cash at a dark time makes, you know, doesn't replace the person, but it gives the family the ability to take a step back and work on themselves to get past that really tough time.
And the beauty of our firm too is, I mean, I've been in the business for a couple years now. I mean, I personally have never had a claim that I've had to deal with, right? So that's something that, you know, I could rely on the rest of the firm and you guys who've had many experiences maybe with that. And, you know, like you said, like that is something that it's amazing to be able to go do and provide that in a time of grief. And, you know, it really is super amazing to be able to do that. And, you know, again, it's the power of this firm and the power of the people that have been in this and be able to pass that down to me, to other younger advisors in this firm as we kind of continue to build. It's an amazing thing, and it's an amazing thing for our clients too.
Brian, I'm sorry. Go ahead, Richard.
In working with advisors, there's a couple of things that I do for advisors. One, I make it, you know, I am now their expert on insurance. And if they have any question at all on insurance, I don't care what it is, they pick up the phone and call me, and I will help them understand whatever it is that they're dealing with. The second thing is educating the advisors about some of the things that we do that they're not familiar with, and some of the ways that our products work that they're not familiar with that enhance what they're doing with their clients.
You know, I want to add, Brian, that's interesting is I feel that, you know, if you look at 4 disciplines, you look at accountants, you look at tax attorneys, estate attorneys, financial advisors, and people in the life insurance business. I feel personally that if you were to ask most of the clients of those 4 disciplines, where do you think there's the least difference in the skill level of people practicing in those fields? I think most clients would say insurance people. I think they view that we're a commodity, all right? That's why the typical thing, I got a buddy who sells insurance, and I think truthfully, if you took those 4 disciplines, I think people in our business is where there is the biggest gap between the top people and everybody else. There are a lot more really good trust and estate lawyers. There are a lot more really good CPAs than there are really good people in the life insurance business. And that dichotomy, that difference is a tough obstacle because it's the perception from the public and maybe even some advisors, although I think advisors have a little bit clearer feel of the differences in the quality of the people in our business. But that's a frustrating element I find sometimes because they underestimate just how much more value they can get from working with somebody that's at the top of our industry.
And growing up in this industry and growing up with father with Tom and with Ron, and growing up with Tom and Ron, I would say that I learned more on less of a what is this specific type of insurance, what is this, and more on a strategy base. So I kind of grew up in seeing how, wow, insurance can be such an amazing tool for so many different solutions, rather than this is insurance, this is term insurance, this is permanent insurance, this is whole life, this is variable universal life. So being able to see that lens, for me, I look at it, I'm like, wow, this is such an amazing tool for people to use. I don't look at it as insurance. I mean, sometimes I don't even look at it as insurance. I look at it as a tax-advantaged way to be able to invest money. You can't qualify for a Roth IRA because you make too much money. There's a solution for that. You could use life insurance for that. There's so many different things, and that's the way I view it. So I have such a different perception, as probably most people you guys know it. You guys have been utilizing and strategizing with it for a long time, but that's what people don't see. So again, that's like hopefully the goal. A lot of this is to be able to share some of these strategies and realize, hey, it's not just life insurance. You're not just paying a premium just to collect something. Maybe in a term policy, but you know what? There's other strategies that can really help your family long term, which is a beautiful thing. It really is.
And one last thing, as information has become so intense and so accessible, I think that people think about getting information about life insurance, getting information about financial planning is easy. Tying it all together is hard, and that's one of the nice things about the way we've created our group and our firm. We talked about the benefit and the power of giving someone a death check and changing their life or keeping their life the same, but then knowing how to help that family implement those dollars into their world, using our financial planning group and our investment advisory team to then help them incorporate that, and figuring out where to take money from and how to spend, and can your life stay the same, and what needs to change, if anything. Tying that all together and having that, I think, guidance, advice, and holistic approach, I like to think that sets us apart a bit.
Yeah, I'd love for you to kind of jump into a couple more different topics and different things that we do on top of the sophisticated estate planning and insurance planning. We obviously provide a lot of other different services and are able to kind of work through with families and add value in other ways. So
maybe it's a place for you to come in and say how you've dovetailed in what you and the whole investment team does once we do the life insurance needs analysis or somebody passes away. And
please, John, please share.
Well, on the wealth side, it is something that's congruent with the overall financial plan, with the insurance plan. When the death benefit check comes in, that's something that we've planned on, right? That's something that we've built into whether it's the buy-sell insurance of someone's business or something completely different. That's built into the financial plan, and then we can turn around and invest those dollars consistent with the plan that they've set out. So all of it kind of fits together to one holistic plan that incorporates insurance, investments, all those different strategies.
Can I add something? Don't you think, Ron, that since a fairly sizable amount of the insurance you guys write is variable life, not forget private placement, but variable life insurance, you're in essence you're involved in managing their money through the product. Unlike if you sell somebody a guaranteed universal life product, you're servicing it, but you're not really managing money. So it's almost more of a natural step from you've been managing that person's policy. Now there's a death. Now you're going to kind of manage the proceeds versus selling a product that you're really not involved at all in managing their money to then getting a death benefit, assuming you're not managing their money someplace else.
Yeah, that's a great point. And I can remember early in my career, mid-'90s, I had my first death claim was a Wall Street executive. He passed away, multi-million-dollar policy. I delivered the death claim, little kids, small children. And I delivered the death claim, and it was, very gratifying to do that, but I had nothing to do. It was a whole life policy, like you described, a guaranteed, non-investment oriented vehicle. I didn't have much to do with it. We weren't really in the investment advisory or wealth management business at all at that point. Fast forward, 20 years, a very different story. We were involved in allocating among the investment advisory accounts within that policy or sub-accounts in that policy. John and the team helping to figure out the right amount and type of coverage and how aggressive to be within that policy. Very good point.
Yeah, and that work has already been done. Like you said, that amount that comes in, like I said, you plan for that, and you know that that's going to then be used in the way that you outlined for the family to use it. It does all kind of works together.
And we're able to project too, right? We're able to see, especially when we're involved on the insurance side and we're investing those dollars inside of the insurance vehicles, we're also able to see their overall overarching portfolio and their investment thesis, right? And we can kind of stay in line with what we're trying to do. And it's an added part of their overall portfolio. is the insurance piece. So it's
but having the tools, not just the tools, the resources, the software, and the experience of the team is critical, because I can't tell you, I'm sure all of you guys can attest to having this in your career, where someone's like, yeah, I think $1 million sounds right. I think $2 million of insurance sounds right. Well, how'd you come up with that number? Just sounded like the right number. Well, based on what? Oh, $2 million is a lot of money. That should be enough, right? So maybe it is, maybe it isn't, but we put a lot more thought and intelligence, for lack of a better word, into figuring out the right amount, the right type, the right structure, the right period of time that coverage is needed based on income, and making some assumptions about the economy and interest rates and inflation. And we factor all those things into making the sausage and helping people figure out the right overall plan. So
can you jump in and Ron kind of touched on that question of, well, how much insurance do I actually need? Like, can you explain how you decide and you're able to help advise your clients on how much insurance they actually need on a pretty basic level?
So there's really two rules of thought in amount of insurance. There's the needs-based amount, where it's typically how much mortgage do I have, what's my debt in other areas, what's my income, maybe I want to cover those debts and provide 1 or 2 years income. It's a very antiquated way to think about things and really doesn't replace that individual, versus in true income replacement, especially for families in their early years, in their growth years, there's something called economic human life value. And so it's, what is this person worth financially to this family over a period of time? I like to explain to families that when you're looking at income replacement, you can assume $50,000 to $60,000 of income per $1 million of death benefit that you can replace. So when you start to do the math, that gets them to think about what it is that they make, what it is they bring home to their family, and then how much they really are worth to their family to replace that income should something happen to them prematurely.
When you have that dialogue with someone, it really does kind of hit home. Sometimes people don't realize, wow, that is actually a monetary numerical number of my worth, and I have a family, and how can I protect that, especially if I'm not here, because you never want to double up a sad time where someone passes, maybe prematurely, and also have financial hardship as well. You never want to double those together. Absolutely. So that's definitely a powerful piece.
Brian, the interesting thing when you use the life value of somebody, it's the example is when somebody dies in a plane crash, a widow doesn't go, okay, well, I probably only need, $100,000 of income, so probably if they paid $2 million, we earn 5% on that $100,000, that's what I want the airline to pay. They would hire a lawyer, and a lawyer would sit there and go, I got a 42-year-old guy, and this is what he makes, and let's go out over the next 20 years, and if he got these raises, and we present value what all of that is, that the guy's lifetime income is worth $8 million, trust me, that's what they're going to try to get from the airline if the plane goes down. But when they're buying life insurance, a lot of people don't think that way. It's like they just, how do I figure out how little, put aside PPLI where it's a different type of sale, but it's always like, how can I spend the least amount of money to protect my family and buy as little insurance as I have to? And a lot of times that insurance amount is nowhere near going to truly replace that person's future earnings.
Well, it goes back into that conversation, even with disability and stuff. When you ask somebody, what's your most valuable asset? They'll probably sit there and think, oh, I have a big home, or, that very fancy painting on the wall, or that business. But when you get them to really think about it, because they'll go and do full replacement value for those tangible assets. Yep. But when you ask them what their most valuable asset is, it's their ability to earn an income to have all of those other things. Yeah. So if they're going to do full replacement value on lesser assets, why not on the most valuable asset to them?
Yeah. That's great.
So as we talked about earlier, some of the work we're doing are with folks who need insurance to replace income, maintain lifestyle, standard of living. Other times we're talking to clients about something and we're talking about insurance vehicles for a totally different reason, right? Buy-sell agreement, estate planning, transferring wealth, minimizing taxes, maximizing inheritance. So whatever the case is, our collective experience, helps us hone in on figuring out a game plan and a strategy around that right type and that right fit, instead of just throwing a number out there.
Yeah. Marshall, can you start talking a little bit more about a family that, per se, maybe over $100 million or so, that may not necessarily need insurance, or they feel they don't need insurance? Can you give a little bit of that?
Sure. So you take a typical situation, a $100 million family, they don't need life insurance. They can pay $40 million in estate taxes, and $60 million would seem like plenty of money for their children, their grandchildren, their great-grandchildren. But people that are high net worth, everyone wants to do a good planning job with their funds. And they think of life insurance as an expense instead of thinking of it as an investment. And the challenge for us is to show how we can use the creative planning that their attorneys can come up with, the cash flow modeling that our investment people can do, and the life insurance options and planning that Richard or I or other people can come up with, to show them how you can have a diversified plan to transfer the highest amount of funds on an estate tax-free and income tax-free basis for the next generation. And you can test the numbers with insurance and without insurance, and tax-free compounding wins out almost every time.
I like to tell people, take that $100 million example. You have a partner in your $100 million. It's the government when you get to that level of wealth. But the government allows you to keep their dollars on your balance sheet while you're alive. And they take it upon the death of the second spouse here. So why not use some of the government's money that they leave on your balance sheet to buy an asset that will allow you to transfer substantially more wealth? Take a 50-year-old guy, $100 million example is a real case. He was going to have a $40 million tax, and net would go $60 million to his family. Instead, we were able to put together an insurance strategy that was going to cost him somewhere in the neighborhood of, call it $6.5, call it $7 million for round number, to buy $40 million of insurance. So in his case, he would pass on $93 million versus the $60 million. Same dollars. He just got to use some of the dollars that were the government's to pass on $33 million more to his family.
And how did you do that?
Buying life insurance with the $40 million of life insurance for the $7 million program we put together.
And in all probability, use the advantages that grantor trusts allow you to, the interest rates that you can use with non-taxable sales and loans to those grantor trusts, the leverage you can get with private split dollar loans and with other types of interest-free advances of premiums. It's just a coordinated plan, and then let the client make the decision of what's their tolerance for complexity and how much do they want to invest.
Split dollar is a way of two people sharing an interest in a life insurance policy. One person advances or loans money, and their interest is the amount of money that they advanced or loaned, and the other party gets the death benefit, whatever is left after the loan or the advance is repaid. Now, there are specific rules about all of that, but the beauty of split dollar is take the example that we just had, and there's a $7 million premium, and the individual has used up all of their unified credits already. And they're going to have to pay a gift tax if they make that premium payment. Well, they can loan the money, that $7 million, to the trust to pay the premium, and it's a loan. It doesn't count as a gift. So they can get the insurance, they have the loan against the insurance, and the interest can be either paid or accrued. And when they die, the loan is repaid out of the proceeds. So that's, from an estate planning point of view, that's a great use of split dollar because you're not using any of their gift tax exemption or any of their annual gifts to fund the policy. So they can do whatever they want with the other thing.
So that's something that comes into play when, let's say, a family did do extensive amount of planning and they were able to gift most of their exemption away, if not all of it. That's another way to still be able to get more out of their estate while not overpassing that threshold.
Yeah.
Yeah.
Richard, would you compare that $7 million loan as just a traditional loan to a grantor trust at, say, 4% interest, and a $7 million private split dollar loan to the trust?
All right. There are rules for loans in the Internal Revenue Code. And the rules say that if you're making a loan and to a trust or to an individual, the loan has to be, the term of the loan has to be no longer than the life expectancy of the lender. It has to be repaid then. The interest has to be paid, and you can either repay the principal in installments or a balloon at the end of the loan. Now, they added a regulation to that section of the Internal Revenue Code that has some things that allow you to do it differently. One, you're allowed to make a loan secured by either the death benefit or the cash value or both of the life insurance policy. Two, you can accrue the interest. You don't have to pay the interest. Three, the IRS can't question whether or not it's a loan, where in the other situation, they may argue that under certain circumstances, they consider it a gift, and you have to pay a gift tax. And the death proceeds are payable at the death of the insured, whenever that occurs. You don't have to worry about the life expectancy. So that's the compare and contrast of the loan Marcia was talking about versus a loan under the split dollar regulations.
But I mean, it depends on who the audience is, right? You know, the clients can probably not follow that, but an advisor will.
Well,
Right.
what a client, the beauty of this arrangement is a client understands a loan.
They understand a loan. Yep.
Now, understand that this is an Internal Revenue Code and that it governs certain things, and that the regulations that govern this allow for certain things about the loan that you can do. You can accrue interest. You can wait until the death of the insured to pay the loan plus the interest. And you can guarantee that the IRS will treat it as a loan. So those are the rules for this particular kind of loan, as opposed to a loan that you'd make, which was for a term where you're collecting interest, whether it's repaid in either an installment or a balloon at the end.
How can a diversified portfolio of income sources help reduce the risk of outliving your assets? And what are some examples of income sources that can provide stability, growth, and flexibility?
Yeah, sure. There are a lot of different ways that you can, when you start looking at retirement planning, you can tackle that problem. You can look at it from, you can basically insure that risk and look at products that do that, like annuities. We do use annuities, and that is one way to guarantee that you will not outlive your money. The other way to do it is just sound investment philosophy. Whenever you invest a portfolio, we want to remove the variable of the investment return over time. And with the way that we manage our money, it's about the predictability of the return as much as the return itself. And so when you have a diversified portfolio that you can count on drawing down your income, that's one way to address it. And then using annuities is another way to do it.
See, the comment that I would make is that to me, I'm not talking about for the super affluent, but, for the,
Yeah.
people worth a few $1 million, even maybe $10 million. I think that people underestimate the chances that they could run out of money.
Underestimate.
I think they underestimate it. I think that, especially where medicine is today, and it's getting better and better, personalized medicine, genetic stuff, all of this, especially if you have some level of affluence, so hopefully you're going to have good care and you're going to take good care of yourself. You could easily have one spouse live, well into their 90s. Most people don't understand what sequence of return risk is. They don't understand that whole risk component of when you get certain performance on your assets. Unfortunately, today, there's a couple of products. I actually bought one of them from One America, but most of the long-term care policies that are out there today, in my opinion, are covering the wrong risk. They're covering the first $1 million of long-term care. Like me personally, I would self-insure for my first $1 million. I want to cover the rest of the long-term care risk. And because most of the products today aren't set up that way, One America, I bought a policy which was not inexpensive that has it's joint survival, lifetime long-term care with a 5% cost of living adjustment in it. And why I bought that policy for me personally is to cover a tail risk. Like if I end up at some point, my wife and I spend $2 million, $3 million on our care, it is what it is. But, you can get Alzheimer's, I'm in my mid-60s, by the time I get in my 80s, you can get Alzheimer's possibly and live for 15, 20 years, who knows? So you could be needing care for 20 years. Could you just imagine like a husband and wife needing care for 20 years from now, how much money that's going to cost to do something like that? And so I think the combination that people either don't have long-term care or the kind of products they bought maybe cover $600,000, maybe $1 million, $1.5 million of their care. They don't understand sequence of return risk. I think there's a lot of people that are going to be in for a real shock if they're fortunate enough to have good longevity, that they could run out of money.
And with the healthcare and the advances in medicine and
Yes.
everything, it's definitely increased that. I'd love to segue directly into, you referenced purchasing a policy for yourself, a long-term care policy, specifically a long-term care policy. There's now products that, that we're able to use and utilize, typical life insurance policies with a long-term care rider attached to it. Can someone kind of get into the basics behind that, and does anyone want to hop in?
So I personally bought long-term care over a decade ago. I started my
Specific.
like a standalone long-term care policy, and the reason I did is I came from, grandparents who were survivors and stuff like that. I watched my grandmother get dementia at 80 and live to 95, and I watched my father take care of her for the 15 years. No mind, but very strong body. So I, at the time, understood the value of the definitions in the contract. So I bought a 10-pay contract that had a 5% compound, that had indemnity benefits, so I didn't have to pay first. They just give me the money if something happens, with lifetime benefits. I saw the direction the industry was going at the time and thought it was important to buy it. So now, fast forward 15 years later, I have a fully paid up policy that will be there. Unfortunately, those types of policies no longer exist because the actuaries of the insurance companies did not properly quantify the risk that was associated with it. We talk about, life insurance is pretty easy to understand. You're either alive or you're dead, right? There's no gray area. Well, the disability in the long-term care market works in what's known as morbidity, not mortality. And so you can live a very long time impaired. So they couldn't quantify that risk. So they started to curtail the benefits that were available to people in their policies. Some of them now, I think you can only get 10 years of coverage, and that's on the high side. So Long-term care standalone is a use it or lose it insurance. You can pay into it and never need it, and you don't get any of those dollars back. So the life insurance carriers have created some products, hybrid contracts, that either have a long-term care focus or have a long-term care rider. And what's good about them is that you can accumulate dollars in these contracts. And if you don't use the long-term care benefit, your family gets all of the money back in terms of the death benefit. Or you can use the dollars in the policy
On death.
if you live too long as a income stream. If you need the long-term care benefit, you will start to whittle down the total benefit inside of those contracts, but they're geared to satisfy a long-term care issue. So that's really the direction the market has gone over the last couple of years due to the very big change in the standalone long-term care products.
They wanted, the problem today is that real tail risk, which is what I insured, because I wasn't smart like you, and I didn't buy the policy when there were other options available. I bought it like, I don't know, maybe 4 years ago or something, and I did a lot of research, and, you know, unfortunately, I think the insurance industry doesn't really have the products that should be out there. There should be like a high deductible long-term care policy. Like, you know, like I'll self-insure the first, $1 million or $2 million, but you, the insurance company, are taking everything above that amount. And there'll be, I mean, just think about it, there'll be a lot of people that will die before ever having care, or will die having not used up that full deductible of care, Or it could be not in dollar amounts, it could be in years. It'd say that your first 4 years of not being able to do 2 out of 6 ADLs, you're on your own. But once you go beyond that period of time, the insurance company kicks in. Obviously, there must be a reason the insurance companies don't offer that product, because they don't want that tail risk, which is the reason I bought what I bought. Even though those products are good that you can combine the life insurance, it's still not covering, it's not covering the tail risk. That risk still exists out there. And I think high net worth people, some people buy, you always get into that argument, the people who need long-term care can't afford it, and the people who could afford it don't need it, There are wealthy people that buy long-term care. They don't have to buy it, they could afford it, they buy it. I actually think there would be a much higher percentage of very affluent people that would buy long-term care if they had a product the way not the one I bought, because mine is expensive, so not everybody's going to do it, but if they truly had a really high deductible long-term care policy, I think a lot of wealthy people would buy that, because that's really the risk, I think, that's important to insure. I'm not talking about someone worth $1 million, $2 million. For that person, getting that first $1 million is important to them. But if you have, a reasonable amount of money, it's not really the risk I think you should be insuring. But I think that generally goes back to what I was saying. I think this whole longevity risk, I think is a big deal. I mean, I know they had like those what are the annuities called? Like the longevity annuities, where like you put a money in, you don't get anything. But when I used to look at like the numbers on it, like it didn't move me. The idea moved me, but they weren't, as typical of an insurance company, they really weren't giving you, in my opinion, what they really should have given you on the back end for all the risk you took on the front end. So I never really did it, even though I think conceptually those annuities are a really good idea for a lot of people, because you're kind of trying to cover that tail risk, which is where I think a lot of the problems are going to occur for people.
See, the insurance companies are looking at averages, and averages are dangerous to look at, because there's always outliers. There's always the people on the front end, and there's always the people on the back end. Yeah. So they're saying, well, the average long-term care event is, 2 to 4 years. And, so we're really thinking that products only need to last about 4 years on the high side. But being here in South Florida versus somebody, call it in middle America, the cost of care is substantially greater here. So, that product could be very good for there, but you'd fall far short here. So, that's something insurance carriers have to kind of understand a little better, is that you can't just base products on averages.
It's really interesting, because I'm telling you, I had a meeting when I was a New York Life agent. I had a meeting with New York Life. It's got to be, could be 15 to 20 years ago. I walked in and had a meeting with some of the people in New York Life. I said, you guys should offer on your life insurance policies that if people go and do certain things, like they go for an annual physical, this was before Vitality came out with Hancock, this was years before Vitality came out with Hancock. I said to them, you give people, as long as they go for a medical, doesn't matter what the medical says, the medical says you're dying, you'll reimburse them for going for a medical, and as long as they do it, you're gonna give them some kind of reduction in their insurance. I said, it benefits you in two ways. A, hopefully people will live longer, so you'll pay your death benefit, but it will give you much more information on your customers. See, today, once you buy a life insurance policy, the insurance company has no idea what your health is after that. It's one time they check you out. But if every year you took it, even though they couldn't change your premium, if anything, they're gonna lower it by showing you when, it's giving the insurance company information. And they looked at me like it went in like here, and then Hancock came out with Vitality, which is something like that, not exactly it, but I have never seen a unique thing come out with an insurance company that no other insurance company ever took. Like John Hancock has it, nobody else has it.
Yeah.
You know what I'm saying? No, and I bought John Hancock.
I have it too.
And
Vitality.
I have trouble selling Vitality because I know nobody's gonna do
love
what
it.
they're supposed to do. I got this thing. I've been platinum every
Oh,
year
me
I
too,
bought.
Steve.
Every year I bought my John. Matter of fact, you need 10,000 points to be to platinum.
Yeah.
I'm not even at 6 months, and I'm at 15,000 points because
Yeah.
I work at it every day. I wear this watch. I do all the things I'm supposed to do. I'm doing what they want. They
And
want
so
me to
tell-
stay
tell
alive.
Everyone, what does that get you? What does being a
Well,
platinum? what is it?
with the Vitality, you end up, if you're a platinum Vitality or you're gold, what happens is every year your premium gets reduced. It's not
Or your
reduced by.
cash value gets increased.
Well, this happens to be on a term policy that I have, so it just
Mine's on a VUL.
yeah, it reduces
So-
reduces my premium, and look, I think it's a smart idea from Hancock's standpoint. I don't understand, why are they the only company that has this? Like, how can
They
not
have the
one?
data.
And
They
I'll,
have the data.
and I'll tell you what, there's times, especially early on when I first got it, I typically pretty active, but there have been times where I'm like, oh, it's end of the month, and I was kind of lazy this month, and I didn't hit as many home runs. Jesus, I didn't have hit as many workouts. I didn't get my steps in, and it forced me to be like, I should probably go get an extra workout. And that little extra, over $10, $15, $12. That you could save, but
So you're an athlete, you're
Yeah.
a competitor.
Yeah.
Right.
See, this is competition.
Track it.
It's
It
like
is,
it's me
totally.
against John
Yeah,
Hancock.
yeah.
It's like the competition
wanna
is
win.
like, yeah, it's like I just want to win.